Okay, exercise 11-14. David Wallace, Olena Dunn, and Danny Lynn were partners in a commercial architect firm and showed the following account balances at the end of the year. So we have our asset accounts, a note payable, an accounts payable, and their capital accounts. Due to several unprofitable periods, the partners decided to liquidate the partnership. The equipment was sold for $60,000. The partners share any profit or loss on the ratio of 2 to 1 to 1, respectively. Okay, so we have to complete the schedule and prepare the liquidation entries. So the schedule is actually on the bottom here. So we start off with the information that was given. So step 1, and they were listed in the book. Step 1 is to sell off the assets. So that is the equipment, the depreciation related to the equipment. Actually, that's all they had. Okay, so they sold that for $60,000. So we clear out the equipment account and the depreciation account, and we increase cash. Now with that, it doesn't show us there, does it, in a calculation? All right. With that, we end up having, sale of equipment for a loss of $11,000. Yes, so they end up selling the equipment. So $164 is the cost of the equipment less the accumulated depreciation. So it is on the books for $71,000, and they sold it for $60,000. So they've incurred an $11,000 loss. That loss gets allocated out to the 3 partners based on the 2-1-1 ratio. So how you do that is $11,000. Now if you have, I'm using the BA2 Plus calculator. If you have that, it's 11,000 times, and then you can use a bracket. And the trick with the ratios is you add them all together. So 2 and 1 and 1 is 4. So 2/4, 1/4, and 1/4. So, 2/4 is a half. It's easy to do, but if you were doing a different one on a calculator that wasn't so easy, it's bracket 2 divided by 4, then the right bracket. So you're multiplying the 11,000 times 2/4. Then you're multiplying the 11,000 by 1/4 to get the other 2 amounts here. So the loss is covered then from from all the 3 partners' capital accounts. Then we have our new balance. The next step is to pay the liabilities, and the liabilities that they have are accounts payable and notes payable, so they get reduced down to 0. They get paid, which reduces then our cash. So our balance now in cash is $58,000, and the balance in each of the partners' equity accounts is listed here. Then we do our entries. So the first entry was to record the sale of the equipment. So they received $60,000 in cash. We reduce our equipment account to 0, so we credit the account $164. We reduce accumulated depreciation to 0, so we do a debit of $93,000, and we record the $11,000 loss on the equipment. Then the loss is shared here between the 3 partners. We record the respective amounts as a debit to their capital accounts because it's effectively reducing their capital account, and we're clearing out then crediting the loss on the sale of the equipment. Then we record the entry to record the pay off the liabilities, which was here, $7,400 for accounts payable and $1,600 for notes payable. So they would normally have a credit balance with the amount owing. So we debit those 2 accounts and we credit our cash. And then we do our final entry then to we had cash of $58,000, so we credit the cash account to distribute that to the remaining partners. And each of the partners, their shares then are listed here, and we debit their capital accounts by that respective amount. So that is that's 11-14.